Hi, this is Mike Larson from Money and Markets TV. After last week's European summit, the region's shared currency saw a bailout rally that sent the euro from $1.38 to well above $1.42. So how long did the rally last? 2 lousy days. After that, the euro gave back those gains and then some, falling to a low of 136 and change against the dollar. What about European sovereign bonds? Another disaster. Italy was one of the key countries that the bailout was supposed to help, but 10-year Italian note yields just exploded to more than 6.3%, a new euro-era high. Belgian and French bonds also got crushed relative to Germany's bonds, a sign that investors are fleeing all but the safest European debt. And global bank stocks, the group most leveraged to losses on risky bonds, they got crushed too. In fact, the collapse in Europe's debt markets claimed its first major U.S. victim on Monday, MF Global. The firm bet heavily on European sovereign bonds, believing they were too cheap. And the CEO, former New Jersey governor and Goldman Sachs bond trader John Corzine, thought countries like Italy and Spain would get bailed out, and more importantly, that those bailouts would actually work. Whoops. MF Global racked up a second quarter loss of more than $186 million. And after credit agencies slashed their ratings on the firm, it was forced to file for Chapter 11 protection. Now that bankruptcy, which will likely go down as the 8th largest in U.S. corporate history, isn't big enough itself to ignite a systemic crisis. But now investors are wondering who else will go down because of their unknown European exposure. I think they're liable to sell first and ask questions later, putting even more pressure on financial stocks here in the U.S. and abroad. Now, all the while, the indicators I monitor that tell me that the global debt crisis are getting worse, not better, and that we're on track for a second recession. Base metals prices, Chinese stocks, Brazilian bank rates, and the movement of currencies like the Indian rupee all suggest that foreign growth is slowing. And that was all but confirmed this week by China's benchmark manufacturing index, which sank to its lowest reading since February of 2009, missing even the most bearish forecasts. And here in the U.S., things are even worse. New home sales and construction are stuck in neutral. The lowest mortgage rates in history aren't spurring sales. Manufacturing and services are both slowing. Consumer confidence just hit its lowest level since March of 2009. Leading indicators are pointing towards recession. Meanwhile, swap spreads, junk bond spreads, and LIBOR rates are all climbing, indicating that bank stress levels are clearly on the rise. Now, you might be able to spin one aberrant economic report or dismiss a single troubling market indicator. But if all of them are pointing in the same direction, you'd be extremely foolish to ignore them. As I've been saying for months now, your best investment bet is caution. That means lighten up your stock exposure and add more inverse ETFs that rise in value when assets like stocks and junky bonds fall. Plus, I'm showing subscribers to one of my investment services how to get even more aggressive with their speculative capital by using specialized instruments that can really turbocharge your profit potential in weak markets. I'm Mike Larson for Money and Markets TV. Thanks for watching.